don't learn to learn, like learn with a specific purpose and then take that action to fulfill that purpose, and then go learn to take your next step. What's the next step that you need to do to get to where you want to be? Because hopefully when we're taking information like this in, we're learning with a goal, an end goal in mind.
Welcome back to Curiosity Class, the podcast where we break down complex topics into easy to understand ideas and bite-sized pieces. My name is Jeff Album, and I've been a curious person my entire life. Inspired by Albert Einstein's quote, "If you can't explain something simply, you don't understand it well enough," we aim to make learning accessible and engaging. On this show, we're going to bring you experts from various fields, ranging from personal finance to physics, to help you understand everything from 401ks to how airplanes fly. So let's dive in and satisfy our curiosity together. Welcome back to another episode of Curiosity Class. I am super honored and humbled to have Amanda Larson joining us today. Amanda is going to be teaching us about real estate investing. So Amanda, thank you so much for being here.
No, thank you, Jeff. It's a joy to be here. I love what you're doing. I heard the concept and I thought that's just such a great idea. I'm a little bit jealous that you get to talk to all these really interesting people and learn so much. So I love the idea. So thank you for having me.
Thank you. Yeah, thank you. I'm really looking forward to this conversation. So before we dive into kind of what real estate investing is, I'd love to just get a sense of your background and, where did you come from? How did you get started in this? And yeah, go from there.
Yeah, perfect. A little bit about my story and my journey. So we'll go way back. I originally grew up in Nebraska, so right in the middle of the US, and grew up there, and I have an engineering background. That's what I have my undergraduate degree in, and it's electrical engineering. And from there, I've lived overseas. I lived in Australia for 7 years, worked in construction management, engineering management. Did all of that, bought my first single family rental while I was there, and then moved back to the US and kept on the real estate journey. Continued to work, but then continued to invest, and just fell in love with real estate, to be honest. I realized what it could do, the power of investing and passive investing. And yeah, so since then, I've just transitioned full-time into real estate, and super excited to share my journey and share whatever I can about my knowledge with your listeners.
That's so cool. Man, there's like a billion things that we could unpack there. I want to start.
We could dive into whatever little nook and cranny you want to. So
Well,
I love this.
I definitely want to start with, so you got your degree in engineering, and then you were working in Australia.
Australia.
Okay.
Yeah.
What did you, and then you said you bought your first single family rental. Was that while you were living in Australia? Okay.
It was, so I was in Australia during 2008, 2009, 2010. I was there for 7 years. So I ended up buying a foreclosure in Lincoln, Nebraska when I was there. So my family always owned single family rentals. So I grew up around it.
Okay.
And there were, big proponents of real estate. So I knew about it, and I was there, and I heard about this financial crisis and all the houses being foreclosed, and I was like, sounds like a buying opportunity to me. Everything is on sale. And so, yeah, my dad being familiar with the market, and also, willing and able to help me, he helped me buy my first single family rental. So a foreclosure in Lincoln, Nebraska. I still own it.
That's so cool. And so, yeah, can you walk us through a little bit more of the details of that deal? How much was it? Did you have to put anything down? Was it, did you get one of those ninja mortgages? How did that all work?
So I bought it, if I remember right, it was just over like $120,000, I want to say.
Okay.
And being a foreclosure, that was a little bit of a different process, but it's real estate is all about relationships. So I was working with an agent who knew the process and who just helped, held my hand through my first loan. It was, I believe I put 20% down. Pretty standard. I know there's deals that you can get where people put less, but I put 20% down, and it was a balloon loan, which was, I think, 3 years, which means I had to refinance after 3 years.
Okay.
And that was my decision to take that risk. It was not required. I just believed that that was a good time frame. I didn't to keep riding low interest rates, and so I did that, and I did that a couple times. But yeah, foreclosure. It needed to be remodeled. I didn't see the house. It was completely, here's an opportunity, and I said, again, it's, well, I think we'll revisit this concept, but it's about having a team and trusting your team. So I saw a good opportunity. I had a team. I trusted in my team, and it was, I just wired the money.
And was your dad living in Lincoln at the time? So did you kind of have him as a boots on the ground, so to speak?
Yes,
Okay.
absolutely. So that's where I grew up.
Got
And
it.
so they owned all their single family rentals in Lincoln. And my dad's a bit of a contractor. So he could fix the mess that was left behind in the foreclosure state. So the whole house had to be gutted and remodeled. And, that's what he does. And so he helped me with that and helped me find renters. And yeah, it's an interesting story about how little I was involved. I just saw the opportunity. I said, everything is on sale. Let's buy. And I guess I was somewhat removed because I was not part of the financial crisis. So I didn't have the same anxiety, I think, that a lot of people that were living through it had.
Mm,
I was overseas. I was on the other side of the world that was not impacted. And so all I saw was, hey, things are on sale. Kind of like right now, commercial real estate is on sale. But because everyone is so involved and they see what's happening, they get anxious. But I think if you can take an outside perspective and you can remove yourself from all the emotions, you can see that this is, again, another really good buying opportunity.
mm. Yeah, definitely foreshadowing what we're gonna be getting into and talking
Mhm.
about a little later.
Yeah, yeah.
Okay, so
So,
you bought that first single family rental. You did it living on a
mhm,
different continent, which is incredible.
mhm,
What was
yeah.
what was the next deal that you did?
The next deal that I did, so I bought that one with never the intention of diving deep into real estate. I just bought that one because I said, I have some money to invest and I see that this is on sale and I can't do this in Australia. I was not a citizen. It was just, the opportunity wasn't there. So that was the only way I could buy. My second investment, I'll called investment, was a house that I built to live in myself.
Okay.
And it was not intended to be an investment, but I figured out that I didn't really enjoy living in a great big house in the middle of Houston. So I turned it into a rental and am now the landlord of that house. And so that's, I would call it an investment. I mean, I think a lot of real estate can be an investment, and you can take real estate where it needs to go. There's different ways to play it. So just because I didn't intend for it to be a rental property, it can be.
Mm,
And so you can pivot and shift in real estate, and that's really important, and what makes real estate, really good opportunity for a lot of people. Because I could move back into that house, I could rent the house, I could sell the house, I could Airbnb the house. I mean, there's a lot of different things I could do with it, which makes it a flexible investment.
sure.
um and around that time I read, I don't know, Jeff, if you're familiar with the Little Purple Book, or if your listeners are familiar with the Little Purple Book, Rich Dad Poor Dad.
Never heard of
So
it.
around that same time, yeah, I read that book and the light bulbs just turned on, and I realized that there's all this other opportunity that can be uncovered outside of what outside of how I thought about investing. And so really it just changes your mind shift on how money works, how you work for money, and how you need to get your money working for you.
Mm,
And so from that point forward, I was like, okay, I have to figure, I made it my mission. I was like, I need to figure something out. And so I started taking courses, going to seminars, and realized all these different areas of real estate that you can work in. Like, I knew of fix and flips, but wholesaling I wasn't really familiar with. I wasn't familiar with seller financing. I wasn't familiar with a lot of the retail, or that single investors could invest in retail or apartment complexes. Just a lot of things that I was opened my eyes to all the opportunity. And the more I dug in, the more I got interested and stumbled on the idea of passive investing, which I know we'll talk about. But again, that was a huge pivot for me, or a big state shift, to know that I could invest without having to be the landlord.
Mm.
Because if you've ever been a landlord, I know my first investment opportunity, I was fortunate that my parents were the landlord for me. But my second house, I'm still the landlord, and it's not passive. There's not, by any stretch of the imagination, is it a passive investment.
So
But
let's talk a little bit
yeah.
about that. So when you say passive
Mhm.
investment versus, let's call it active investment, right? Break down
Yes.
what's the difference between the two? What do those each mean?
Okay, so I'll start by saying a lot of people, in my opinion, use the word passive investment a little bit out of place. Like, they will say that owning a single family home is a passive investment. All you do is collect the rent. Well, that's not all you do. You also answer the phone call. You also answer, when the air conditioner breaks on, and it only breaks on a Sunday. No one will tell you this, but things only break on Sundays. um, and so that, in my mind, is an active investment. You are there making sure that the renters are paying rent. You're there making sure that everything works. They call you to fix things or to have things fixed. A passive investment is when you are investing in somebody else to do all of that for you. And this normally comes into play on larger investments. So, just as an example, right now I invest in apartment complexes. And so, because unless you have the means, most of the time one person cannot buy an apartment complex. So, you will have sponsors, who are the active investors, go raise money from limited partners, who are the passive investors, who only want to put money in. So they are almost buying shares in that apartment complex, and they are benefiting from the cash flow from people paying rent and the appreciation from that piece of real estate. And so all a passive investor does is put money into the deal. So it's kind of like no harder than buying a stock. You're just putting money into the deal. You put money into the apartment. It can be retail. It can be a portfolio of homes, but that's it. And then you just sit and you wait for your money to come and cash flow, and then appreciate and make money on the sale on the backside.
Gotcha. Okay, and that's called a limited partner, you said, right?
That's called a limited partner. It's different terms. Limited partner, passive investor. They're used interchangeably, and I'm guilty of using them interchangeably as well. So
Got
not
it.
yeah.
And so the idea being
Mm-hmm.
that a limited partner, an LP, is someone that they're just bringing money into the deal, right? So they're not doing
Mm-hmm.
any of the work, right?
Yep. Yep. And so this is a great opportunity for people who believe in real estate, like the idea of real estate, want to get out of, diversify or get out of the stock market, but don't want that hands-on activity. Usually oftentimes they're busy professionals who are love their job or busy working on their job, but they have capital to invest. And it can it can be it's a great opportunity, and once people realize the power of it, people get really involved in it. So we have a lot of investors, high income earners, or just busy people who want to invest in real estate. It's a great fit for them.
Sure. And is there any limits on who can invest in these deals? Can anybody do it? How does that work?
Pretty much anyone can do it. Now, I will say that there's different regulations. So each I'm going to call them deals. Each deal will have a set of regulations behind it. And depending how that deal is set up, they'll have different limitations on who can and cannot invest. So I'll start with, I'm going to throw a we're going to start, I know this is, we're going to talk like, is it third
Third
graders?
graders.
Is
Yeah.
third graders? Third graders. Okay. So we'll call one type of deal, it's called a 506B.
Okay.
And don't let, like,
don't worry about the
you don't need
numbers or
to
the
know
letters.
that other than we'll call it the B group.
Okay.
To invest in that deal, you need to have a relationship with the general partner or the sponsor. So that's the active investor. So in order to invest in that deal, you just need a relationship with that person.
And the active investor,
or that group.
what do they do?
Mm-hmm.
What's their role?
They find the investment opportunity, they underwrite the investment opportunity, they come up with the business plan, they secure the debt, they raise the capital, and then they operate that asset or that piece of real estate all the way through the hold period.
Got it.
And they are the ones that make sure that they either have property management who are, make sure that people are paying rent, everything is fine, all the bills are being paid, that the property is performing. So they're doing all the work leading up to the purchase and then all the way through the sale.
Got it.
So
they kind
in
of,
this B group, sorry, go ahead.
Oh no.
Jeff?
So I was just going to say, so they're kind of doing all the work associated with the deal. Mm-hmm. They need the money to basically buy the deal. So they're going to go out and raise that money from a bunch of limited partners or passive investors. The passive investors are going to pool their money together, give it to the active investor to then go out and do all the work, find the deal, buy the deal, operate the deal, and then give people, the limited partners, their cash flow as dividends, basically. Is that correct?
Yep. That's exactly right.
Okay.
Exactly right.
Cool.
Yep.
Okay, so now we're back to the B group.
Yep. The B group, yeah. So if it's a B deal, you need to have a relationship with the sponsors or the active investors, the general partners, and show a certain amount of, they call it sophistication, but it's just a certain level of knowledge that you know the risks of the investment, that you are a knowledgeable investor, and that you know what you're getting yourself into, because it is not as regulated as some other investments. It's really just a protection for that investor, that you're not being bamboozled by somebody who's just trying to raise capital.
Sure.
So,
and is there like a test? How do you prove that sophistication, that you are a sophisticated investor?
So if I'm an active investor, it's really a conversation with, like, if I had a deal, Jeff, and you were interested in investing in it, it's really a conversation with you about, what's your investing, history, what have you done, are you knowledgeable about real estate? And then in the legal documents, there is a little bit of a questionnaire to make sure that we've had this discussion and that you do recognize that there's risks involved. But no, you don't sit an exam. It's more of pretty basic, but telling questions that really you're a knowledgeable person.
Gotcha. So it's kind of up to the discretion of the active investor to basically make a call. Like,
it is.
This person's good. This person is maybe needs more learning.
Yeah, and there are times when I talk to investors, and it's it's probably better for them just to go get a little bit more knowledge because they don't fully understand that. It's more about understanding the risks involved, and that it is usually a significant amount of capital that you're putting in, and that capital, like any investment, there's no such thing as a risk-free investment. That capital can be put at risk.
Sure. And just to be clear, capital in this case is money, right?
Is money.
Yeah.
Money. Yeah.
Cool. Okay, so the B deal is anybody that has a relationship with the sponsor or the general partner or the active investor, all synonyms, is able to have a conversation with that person and make a decision. Hey, is this person sophisticated in understanding this investment opportunity?
Yep.
Okay.
Yeah.
Cool. What are the other types of deals?
Yep. So the other type of deal is, we're going to call it the C deal.
Okay.
It's a 506C. And so, in order to invest in one of those, the criteria is a, it's just different. I won't say it's more burdensome. It's just different. The criteria is you have to be an accredited investor, and that simply means that you make either enough money or that your net worth is, I think it's over $1 million. So it's more about financial means and not knowledge based or not relationship based. It just means that you have the money, the spare money to invest.
Gotcha.
But you don't need to know the sponsor. So if I'm a sponsor and I have a deal and I want to go raise money from accredited investors, meaning they are financially qualified, I can then advertise that deal however I want. So I can go on Facebook or Instagram or however is going to attract accredited investors, because I don't then have to have a relationship with them.
Gotcha.
They just have to show that they have the financial means to do it. And then in this instance, there is a qualification. Like you do have to, the investor does need to show that they do meet those financial requirements.
Gotcha. And so an accredited investor, that's someone that you said has that kind of financial means, and it's a net worth requirement or an income requirement. And so the big difference between and that's for a C deal. So the big difference between a 506B and 506C is a 506C requires the limited partners to be accredited.
Yeah.
Right? Okay.
Yeah.
Cool.
Yes.
Small tangent.
But no relationship is required. Yeah, of course.
What are your thoughts on this whole accreditation thing? That requirement.
In terms of what? Like, I know that there's talks about them changing it. I know that, there's different, third party requirements. What specifically are you asking?
I guess it just kind of blows my mind that it's totally fine. You can go and spend an unlimited amount of money in Vegas on slots or in poker, and you have no requirements to show, hey, I know what I'm doing here. You can lose all of your money and then some, but you don't have access to certain real estate deals just because you don't have this set amount of money or net worth. Like it blows my mind.
Yeah, it does. It doesn't make sense. The one I say, they say it's to protect the investor, because there's a lot of really good people who are good at marketing.
Sure.
And that can get people to put their money into deals. So they say it protects the investor because there is risk involved, and these deals are less, not supervised, but there's no one keeping a close eye on them. Like if you go invest in the stock market, usually those companies have to submit their financials all the time, and they get audits, and it's very regulated, where these are a little bit less regulated. And so no one is watching over some of these sponsors. These sponsors, I would never do this, but I can put together any pitch deck that I want and tell you that your returns are going to be whatever I want, and I don't have to show anything.
Right.
So there is some protecting the investor, but then there's also a little bit that protects the sponsor as well. Because if you then say that you're knowledgeable and you understand the risks and you have the financial means, that makes it harder, I believe, for you then to come back to me if things don't go as planned. If you're not happy with your deal. I think there's a somewhat famous, I don't even know all the details, but there's a well-known sponsor who's getting sued right now from an investor for a very small sum of money, just because the return, I don't even know what happened. The returns aren't what they thought they were, and it's not very much money at all. And so it protects both sides, I think.
Got it.
Yeah.
All right. Fair enough.
Mm-hmm.
Fair enough. I just feel like there could be like some sort of test, right? If you pass this test, that shows like, hey, I know what I'm doing. I know what I'm getting myself into. Maybe I don't have this certain net worth requirement or whatever, but I am opting into this thing that I know is risky.
Mhm.
And here's my test score. I passed it.
Yeah.
I don't know that.
Yeah. No, I agree. I think they're coming out with something, or it has come out, and I wish I knew the details. I know they've been talking about it, that you can test out of it. But I don't know how many people would do it.
Right. No, it's totally fair. And I think you made a good point about,
Yeah.
the protection is kind of on both sides. It's protection for investors and protection for
Mhm.
sponsors, which makes a lot of sense. Um,
Yeah.
so
And I will say that if I'm raising capital for a deal, people, it is, so to put some numbers behind it, usually a minimum, just in general, not even mine, it's usually $50,000 is the minimum.
gotcha.
And it can range from 25 to, I mean, it can, sometimes I've seen minimums of 100. So it's not a small amount of money, and it's tied up, and it's not liquid. Like, you can't come to me like a stock and say, "Hey, I want my money back, and I'll give you your shares of your apartment back." No, once an investor invests, that money's locked up until the deal sells.
And how
And
long does that
so
typically take
usually the business plan, and this will be in the business plan, but sometimes business plans don't go
to plan?
precisely as to plan, because we have things like the economy, we have financial disruptions, and whatever happens. The business plan, most of them that I see, are 5 to 7 years.
Okay.
Now, we went through a phase where a lot of things were selling in 2 years, 3 years, but those things have shifted now, and people are holding on to deals longer. Um, and it's going to be, in my opinion, I think it's going to be more like that 5 to 7 years.
Gotcha.
And you will get, ideally, the investor will get distributions, but to get that big chunk of money back, it's 5 to 7 years. And you can't go and say, "Hey, I want my share. Here's your shares. I want my $50,000 back." And
Sure.
so when I'm raising from investors, I also want to feel comfortable that they don't need that $50,000, because you don't want to take, we don't want them scraping their bank account for them to invest in your deal.
Sure. Sure. So if
Mm-hmm.
someone invests $50,000, let's use some real numbers and try to figure out, what the math works out to. Someone invests 50 grand
Okay.
into a deal. What's a typical return that they can expect? Like, how much can they expect to get back, both in terms of distributions and when you go to sell the building?
Okay. So let's start with just a total return. Combine distributions and your your upside on the sell.
Okay.
So generally what we target, and what I've seen other sponsors target, is a total return of a 2x multiple or 100%. So if you would invest $50,000 between distributions and return on sale, you would get your $50,000 back plus another 50,000.
Got it. Okay.
And that, I mean, there's some room in that. I've seen from like a 1.8 equity multiple to 2.1, but generally speaking, it tends to be in that 2x your money, double your money
Okay.
throughout the business plan.
And
Yeah.
so that's an interesting point that I want to touch on is, so let's say you invest 50 grand, that's called your
Mhm.
principal, right? Or we'll call that your principal.
Yeah.
So your
Yep.
principal is 50 grand that you put into this deal with a bunch of other people putting in 50 grand as well. So
Mm-hmm.
we're not really going to worry
Yes.
about the other people for now, but that 50 grand goes
That's
in,
not.
and you're then returning both distributions because the building is hopefully generating income and throwing off
Mm-hmm.
cash flow,
Yeah.
right? And
Yeah.
so I'm getting those distributions on my 50 grand. And
Mm-hmm.
after you've executed the business plan, the idea is that the building will sell for more. So then
Yes.
once the building sells, I get my initial 50 grand back plus whatever is on top. So
Mm-hmm.
is the equity multiple both including distributions and the building going up in value?
Yes. Yeah.
Gotcha.
So
Okay.
the equity multiple encapsulates everything.
Got it.
Yeah.
Okay. So 50 grand in, 100 grand out is a 2x
Yep.
equity multiple.
Yep. Yep.
Gotcha.
Exactly.
Okay. Cool. And so that's a typical targeted return on some of these deals.
That's in what I see. That's usually what sponsors are targeting. There are different, just like a caveat. I think if your investors are more institutional investors or family office type investors, those returns look a little bit different what they target. But for the retail, and I'm going to say retail just being friends, family, people that you know, people that you raise money from, not the billionaires of
Okay.
society. We're just going to talk about your retail investor, just like you would talk about a retail investor in the stock market. It's just your people investing and not big institutions like insurance companies or something like that.
Gotcha. Because those institutional investors also invest in these types of deals.
They
Or they
do.
can.
They
Okay.
do. They can. And those returns, I think, are a little bit of a different profile just because they have different needs and requirements and pain points that they're meeting. They're more concerned about preservation of capital and different timelines than you or I would be. They have
Gotcha.
different problems than we do.
Yeah. It's a good
Add a
problem
few
to
more
have.
zeros for our bank accounts, and then we can maybe relate.
Oh, it's a good problem to have.
Yeah. So yeah, back to it. Generally, what I see is that to double your money in 5 to 7 years is what most sponsors are targeting for their investors, and that's really what investors are looking for. And that's changed a little bit over the last couple of years, but as times shift, expectations shift, and we'll see what happens moving forward.
Gotcha. And when we're thinking about the return you can get in a real estate transaction like this, if we want to compare it
Mm-hmm.
to, let's say, putting your money in the stock market. So I think
Mm-hmm.
historically the stock market generates, I think on average, what is it, 7 to 9% every year. That's the idea, right? Over
Okay.
a long period of time.
Yeah. Yeah.
So if or if you were to take that same 50 grand and put it into the S&P 500, like a very basic, boring
Mm-hmm.
stock market account, and let's say it grows 7%
Yeah.
every year over that same
Mm-hmm.
7 year period, what kind of returns can you expect
Mm-hmm.
there as opposed to real estate?
Well, if it's 7% a year, that's not, if we just take simple math, 7% a year is, you're not going to double your money
Right.
in 5 years. Whereas, if you do an average cash on cash, so let's make simple numbers. If you double your money in 5 years, you have a 20% average cash on cash, 20% every year.
Right.
Um, so in my opinion, generally, depending, you can't time the market, but generally speaking, real estate tends to perform stronger than just the S&P 500. Now, if you pick different stocks, I'm sure you can find different stocks that perform better than others.
Right.
But
Or if you're Warren
yeah,
Buffett.
yeah, or if you're Warren Buffett. And not to go off on too much of a tangent, but also one of the, I guess, powerful points about real estate is that I know while there are dividend paying stocks, real estate tends to be heavier on the cash flow. So then you have the opportunity to take that cash flow and reinvest it and keep your money moving, because the velocity of money, or how quickly you can get your money back and reinvest it, can make a big difference in your overall outcome as well.
Gotcha. Yeah, because the whole time
Is that
you're generating this cash flow that you can go do stuff with.
mm-hmm. You can do stuff, and you can, maybe you want to go on a vacation, but if you really want to if your main goal is to maximize your outcome, you can then put that money back into another investment and get that money making money for you again.
Sure.
So the whole idea is get your money making money for you, so you don't have to make money for yourself with your time.
Right.
So the more quickly you can get that snowball and that flywheel going, the more quickly it can grow, and you can start, it can be life changing.
I love this idea that you're bringing up of the snowball and the velocity of money. I think it's a really good
Hmm.
point. And just in the sense
Yeah.
of like, I know when, I read Rich Dad Poor Dad and having that
Hmm.
understanding of like, whoa, I've always
Yeah.
thought of time equaling money. So like the more
Hmm.
time I spend doing something, I'll get more money because
Hmm.
I've worked more. But then realizing that
Yeah.
like, wait, you can separate that and you can have stuff that where you're making money that's not tied to time was mind
Hmm.
blowing to me. It still
Yeah.
is.
It still is, and it's. I'm sure you had the same experience when you read that book. It was just like, this light bulb just comes on, and you go, "I had it all. I had it all wrong,"
Yeah.
And I kind of knew growing up in a family that did a lot of, some real estate investing. I kind of knew of the idea, but I mean, they didn't, I guess, they didn't have all the same resources that we have now. I mean, my dad didn't grow up watching YouTube videos on how to invest in real estate and how to maximize returns and syndications and all things like that. He just knew like, um, yeah, my kids need to go to college, so let's buy a house, and I need to retire someday, so eventually the cash flow can pay for my retirement. That was his plan.
Right.
And now with all the education, I guess we can understand it. We have the opportunity to take advantage of the opportunity a little bit better and, be a bit more efficient with our money.
It's so true. And I guess I want
Hmm.
to ask you is so obviously, like I love this quote that if information were the answer, we'd all be, billionaires with six packs. Right. So like there's
Yeah.
such a plethora of information out there for free on YouTube. If anyone has
No, yeah.
an internet access, you can learn all this, right?
Hmm.
Um, but obviously you're someone who's done it, right? And you're doing it. And you're in the trenches day after day. So what do you think is a good reason, or why do you think that more people don't actually do it? What do you think it takes to actually start in this industry as opposed to just learn about it?
One is fear. One is fear, and then there's a difference between learning and doing. And so people are worried about the fear of loss keeps people from investing a lot, I think. Um, they don't feel comfortable. When I talk to some investors, part of it is control and people just giving up that ability to get their money back and fear of losing. They're giving somebody else their money to be stewards of their money. And that's really hard for some people. The other thing is analysis paralysis. They want to see 100 deals and they're waiting for the perfect opportunity, or they always think there's a bubble, and they want to analyze and analyze and analyze. And with a lot of these things, the opportunities come and go pretty quickly. So if I just using real estate as an example, if there's a deal to invest in, sometimes that opportunity to invest is only, I mean, I've seen it as short as a couple of days to maybe, it can expand to maybe a couple of months, but it's really about getting comfortable and going with the unknown, because you can never predict the next 5 to 10 years. You just have to trust that the person you're investing with is going to be the best stewards of your money and take the best care of your money as they possibly can. And
Mm-hmm.
that's hard for some people. And then I think some people just don't take action. We all know those people that are always going to do something. They're always
Right.
going to start that hobby. They're always going to use that gym membership. They're always going to learn whatever it is. And they can continue and continue to watch videos and learn and learn and learn, but learning isn't doing.
Right.
And so I'm a big person on mindset. So oftentimes, I talk to people, or I post a lot on LinkedIn about don't learn to learn, like learn with a specific purpose and then take that
Mm-hmm.
action to fulfill that purpose, and then go learn to take your next step. What's the next step that you need to do to get to where you want to be? Because hopefully when we're taking information like this in, we're learning with a goal, an end goal in mind. So if you break that down into steps, like what do I need to do to accomplish step one? Go learn that and then do step one. Okay, what do I need to do to learn? What do I need to learn to do step two? Okay, do that. Go learn that, and then do step two. But learn, do, learn is kind of this circular loop that I like to talk
Mm,
about a lot, because it can get overwhelming. There's a ton of information out there, and everyone has a little bit of a different take, a little bit of different advice, and it can be confusing and overwhelming. So, like I was saying, it's just that learn, do, learn, and learn with purpose, so you can then take action to go reach your goals.
mm,
Yeah, and then just staying focused. I think people lose focus, they get distracted, and they forget how important their finances are, and they go get distracted by whatever's going on the weekend or whatever they are. Where if you focus a little bit of time on your investments and your personal finances, you'll have more time in the future
mm-hmm.
because you won't have to work as much. You'll have different options. But
Yeah,
it's trading time, it's that investment upfront.
sure,
So,
sure. I want
yeah.
to ask a couple different questions about, because you said
Hmm.
that you were an engineer for a long time, for a big part of your career, and then you made the switch
Hmm.
over to full time investing. So I want to ask a
Yep.
little bit about what that was like, because that's a pretty big
Okay.
transition.
Yeah. Yeah. So I was engineer, project management type roles all the way up until I became full-time real estate. So I worked we can I won't digress too much, but I was a site engineer. So I worked on large construction sites. That's how I got started. Um,
Okay.
Imagine me with a hard hat, fluorescent vest, and boots. That was me for a while. And then I worked on in design, and then I worked in the litigation space. So it's actually where construction projects go into dispute, um, and then they hire advisors on what happened. So I did that, but all this time, not all the time, but the last probably 6 years I was working, I had investments happening in the background, and my first apartment investment was as a passive investor, but as I learned the power of it, and learned and got to know people in this space, I just started putting more time and effort into that outside of my day job. So I was working full time, and then on the side I was kind of growing this, investment portfolio and learning more about real estate syndications and signing up for classes, signing up for mentorship programs, all with the intent that someday that I could also be one of those sponsors, one of those GPs. Um, Simply because, well, I believe in the power of passive investing. It's something that I really enjoyed. I enjoyed it more than my day job. And so slowly I made that transition. And in my engineering world, I worked in a very cyclical market. There was multiple cycles that I went through, multiple layoff cycles. And so, yeah, a little, I had some help making the final decision. And luckily I, had some other things happening on the side, which made that last cycle a little bit easier to work through. And so
Gotcha.
that's kind of how it happened.
Gotcha.
And just to speak a little bit about that, I think a lot of professionals, especially more so now than it used to be, are cyclical industries. And so if you can have multiple streams of income, I can speak personally that it can make those cycles a lot easier to work through.
Right.
It's just not nearly as stressful if you have other income coming in. So,
Right.
yeah.
Well, and there's no downside to that, right? Like there's no downside to having multiple streams of income,
No, it's just
right?
the only downside is maybe delaying the gratification that you can get from that money upfront.
Mm,
So instead of going and spending the money on a new car or whatever you want to spend your money on, you have to delay it a little bit, invest it, and then get the start growing that snowball.
right. Right.
Grow the
So
snowball and don't just like throw the snow.
so you have a very unique position in that you've acted as both a general partner, a GP, the active
Hmm.
investor, and a limited partner, a passive
Yeah.
investor, in other
Hmm.
people's deals. So
Yeah.
when you're looking to vet a sponsor, what are some things
Hmm.
you look for as an LP?
Yeah. So as an LP, you know, all LPs always ask the question, and they as they should. How do I know if it's a good deal or a good sponsor? And finding a good sponsor will make or break a deal. Just because it's a good sponsor, it may not work exactly as planned, but if it were a bad sponsor, bad sponsors can kill good deals.
Mm-hmm.
Um, it's a lot of things are intangible, but you can ask for their track record. You can ask, you know, and they'll always tell you, here's the deals we've done, here's the returns we've given. Some other things to look for is how do they report information back to you? How often are you going
Mm-hmm.
to get updates? My experience and what we do is monthly. We send all of our investors, here's how the property's performing. Um, here's the occupancy. Here's how much cash flow is coming off the property. Here's how or why we can or cannot, distribute this month. Here's everything that's going on, capital projects, how the business plan is going. And then the biggest thing, one of the biggest ways to learn about a sponsor is to go ask other people that have invested with them in the past. And usually then you'll get a more clear, honest opinion. Just because a sponsor's going to tell you a lot of good things, and most sponsors are honest and they'll tell you deals that have not gone quite as well, but they don't know what the experience is as an investor. So I'll tell new investors, hey, go talk to people who have invested in our deals before. And that's exactly what I did. I talked to people when I was vetting a sponsor. You've invested with this group. What's your experience? How did they treat you? How did the deal go? Did they do what they said they were going to do? And this is not as tangible, but when I'm speaking to a sponsor, a lot of what real estate is solving problems and being able to work with things that come up, because like I've said, none of us can predict the future, but being able to pivot and being able to actively solve unique things that come up is a skill that not a lot of people have. Um, so if I feel people are being almost too formulaic with their plans, and maybe they can't take something out of left field and take it on board and go wrestle it down and solve it, that might not be, rightly or wrongly, that's probably not who I'm going to invest with. I want that person who can, you can throw them in whatever problem and they'll find their way out, right? Like
Right.
this very, I don't know, you can't almost describe it other than I feel like you could solve problems.
Right. 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 Right.
Does that make sense?
Yeah, for sure. Like a scrappiness, a certain level of
It's
scrappiness.
scrappiness, because there are some, and there's nothing wrong with this, but there are some sponsors out there for me. You can become too robotic and they think
Sure.
everything works in a spreadsheet.
Sure.
And we do work in spreadsheets a lot, but once you get to the property, that spreadsheet doesn't matter. No one cares about the spreadsheet
Right.
anymore. No one cares that just because you planned on this happening, it's in your spreadsheet. It doesn't matter. Like,
Right.
I need somebody who's out there, real life, out there, like making sure the property's running, regardless of what you put in your sheet.
Right. Right. Oh
Yeah.
man, that's awesome.
So I don't know if that makes sense, and it's hard to tell people that. Like, get to know the sponsor and how well can they take your money and just go make sure that your money's working for you.
Right.
It's almost like, can you teach common sense?
How much or how important do you place, or I guess, so let's say you're evaluating a new sponsor. How
Mhm.
important is it to you that you get along with them personally? Like, is that a thought that you have of like, hey, I like
Mm,
spending time with this person. I like they see like have a good vibe. Is that important to you, or not so much?
for me, it's not. That's a really great question. It would depend. It would depend on what, like, sometimes you don't always. That's a great question. I think I would have to, I do need to find them approachable. I do need to find them to be usually you're gonna if I find somebody approachable, I'm probably gonna like you. But I don't necessarily need to go have dinner with you and enjoy having dinner with you. I just need to
Mm,
know that you're going to be good stewards of my money. And
mm,
oftentimes, if it takes me a lot for me not to like someone, like if I feel like you don't have high integrity, that's one thing, and then I'm not going to invest with you anyway. But I don't necessarily need to be buddy buddy with you or spend the weekend with you. I mean, I don't most of the time. There's a couple sponsors that I have become friends with, but being friends, but being having respect for them, I think is important, and them having respect for you is very important.
mm.
Um,
Gotcha.
yeah,
Gotcha. Okay. Very cool.
that's a really good question.
I'm
I
just
don't
always so
think anyone
curious, like
ever asked
what role
that.
that plays in people's lives. I have the same question because you said you mentioned a couple of mentorship groups. Like
Mm-hmm.
same thing with that. When you're looking for a mentor, how important is it
Mm-hmm.
to let's see. So okay, for example, if
Yeah.
someone is crushing it in the real estate industry,
Mm-hmm.
but is like constantly cheating on their spouse and like not being a good person, I don't
Mm-hmm.
want to learn from them, right?
Yeah.
Like I don't like
Yeah.
holistically we don't align, but they're
Yeah.
crushing it in real estate, right? So
Mm-hmm.
I guess that was obviously an extreme example. So when you're looking for a mentor, how important is that holistic um, alignment to you versus I want to focus, I can learn, something from anybody. I want to focus on this one thing and everything else. Like it's okay if, we're not so aligned.
Mm-hmm.
How do you think about that?
For me it's important to be in line. Like for me to listen and take on board and really integrate into my life what you're saying, I need to be able to respect you and kind of like you. I mean,
Mm-hmm.
I need to want to get to know you and want to follow you and like follow in your footsteps. And if I don't have a lot of respect for you, or I think you're of low integrity, or even if it's, there are some mentors out there who just almost just whatever, something about them just rubs me the wrong way. I can't put my finger on it. I'm probably not going to join their mentorship program because it's just something I want to be. I need to want to be around them, and I need to almost want to not always model them, but model what they're doing. I think, and
Sure.
that's really the idea of a mentorship program. So,
Sure.
yeah,
Can you speak to which
yeah.
specific mentorship programs that you've joined and kind of how you've liked that
Hmm.
process? Because I've heard a number of things from different people, and so just curious for your perspective.
Yeah. So I joined. So I've been in a couple mentorship programs. So the one that's most relevant probably to this conversation is it's called the Sumrock program. Brad Sumrock, he's out of Dallas, and he was probably when I was getting started one of the first one not the first but one of the first real estate syndication programs available. And he's really big in Texas. You're in Texas, so you may or may not have heard of him, but a really big network, and a lot of that beyond just his coaching, because that's a smaller component of it, was just the size of the network. So it seemed that when I was getting started, you'd attend networking events or 10 real estate events, and everyone was part of this network. I mean, it's not quite like that anymore, but they were all in his program. So, kind of to get your foot in the door, you almost needed to be part of that circle. Like you're paying you not pay, you are paying money, but it's almost like an entry fee to get into that network, almost like a club. And
Gotcha.
the learning comes with it, but it's more about the network. And then the other mentorship program that I'm in right now is more about capital raising, and that is, that's Raise Masters with Hunter
Oh yeah.
Thompson. Hmm.
Okay. He wrote the book on it, right? How to
He
or
did, yeah,
yeah, I think I have
yeah.
that back there.
Do you have it? Oh, yeah,
Yeah,
it's a really great book. Yeah, yeah.
yeah.
And
He's
again,
is.
it's sorry. Go ahead.
Oh no, go for it.
I was just gonna say again, most programs there's a learning component in terms of the information and the education, but then a lot of it is the network. And usually, in my experience, is if you can find the people who not just the mentor, like the person at the front, but if you can find people in the group that you know of and that you really like and that you really respect and that you can learn from them, that's another reason to become involved in the group.
Sure.
Um, and mentorship programs, people have different opinions on them. I think it's a personal opinion if or personal choice if you're going to join them or not. They work really well for some people, regardless of what it is. There's a lot of work that goes involved. Like the mentorship program is not going to do the work for you.
Sure.
Um, but
What?
uh, yeah, it's just finding one that really resonates with you. Like going back to your first question, like you need to be there and feel like, okay, are these people my people?
Right. Right.
Can I be a part of this group and feel like I fit in and really network with people and get to know people and have fun and learn, and being in that ecosystem, like it'll either speak to you or it won't. And
Right.
so that's just, everyone's different.
Was there a period of time where you were against mentorship groups, and then did you like what put you over the edge to then join
Mhm.
one, or kind of were you always a fan of them?
I've ebbed and flowed, to be perfectly honest. There was one before I joined Red Sunrock's program. I was part of another one, and that was very much one a lot of us have heard stories. You go to this 3-day conference, then they
They
send you
upsell
to the
you
back of the
everything.
room with a credit
Yeah.
card, and I was one of those. I took my credit card and I was all in, and my experience with that one is it just didn't deliver, and I didn't get anything out of it other than it just kept my wheels turning in real estate. And in that sense, it was valuable. But in terms of what they said they were going to do, and the opportunities, and so after that experience, I was much more hesitant on which programs and if I was going to join a mentorship program again. Um, and I still am hesitant. I still don't jump into something. I get to know it. I talk to people who are involved in it. I get to know the people. I do whatever research I need to do to make sure that it's going to resonate with me
Mm-hmm.
and that people are having good experiences with it. Um,
Mm-hmm.
there's never going to be a situation where if you don't run back to the room, they're not going to take your credit card, a month later or 3 months later.
Right. Right.
I promise that. And what I will say about mentorship programs, almost why I do think they add a lot of value is there's a ton of information. Like we spoke about this before. There's YouTube, podcasts, books, no short of information, but you find what you're looking for and not you don't find what you're not looking for. And in mentorship programs, oftentimes you'll learn something that you didn't know. So you'll be on a call or a group call or whatever you're doing, and they'll present something or somebody will ask a question and you'll say, I never thought of that. I didn't even realize
Mm-hmm.
I didn't know that. And if
Mm,
you weren't part of this group, I'm not going to go searching for that. And for,
sure.
a lot of times stumbling on something, especially in real time, is not going to happen. So part of the groups is pointing out to you what you didn't even realize you didn't know. And then also it's so immediate, like especially right now in these times, we didn't dig into interest rates or anything or, state of the market, but it's in constant flux. And what you
Mm-hmm.
learned last month on YouTube is already out of date today.
Right. Right.
So it's staying constant on what's happening in the market, what people are doing, what to expect, how people are, you know, formulating their business plans, what prices people are paying, the whole gamut. You learn what people are doing today, not a month ago when that YouTube video was made.
Released.
Yeah.
And in your company as it stands now, how many are you partnered up with people? Is there a team in place? Is it, is it just you?
Mm-hmm.
How does that work?
So for me and my company, it's just me. When I do we call them deals. When I do a deal or a syndication with an apartment, then I always partner with people, and I've partnered. I had that great opportunity of partnering with the same group where I did my first LP investment, so I got to know them,
Cool.
and yep, came full circle, and became really good friends with them, and we work well together. So I partnered with them, and then I've partnered with people that I met through my mentorship programs on a deal in San Antonio. So
Cool.
right now it's just me and my company. I'm talking to a few people on, growing and becoming more of a ongoing partnership, like a business. But right now it's me partnering with other people to do real estate deals.
And so how does that, so like, let's say, you bring, let's say 10 people with $50,000. So that's 500 grand.
Yep.
Are you, when you say partnering with other people, so like the group that you did your first LP investment with, so you're coming to them
Mm-hmm.
and say, hey, I have these 10 people who, we have this much, we have 500 grand as an investment. I want
Mm-hmm.
to co-sponsor. Like what does that relationship look like?
Yeah. So how what I'm talking when I'm saying partner, it's more like it's more the GP's partners. So there are, generally anywhere from two to call it five general partners, and they partner and they each have roles like somebody focuses on generally asset management or underwriting or finding deals, and everyone raises capital, and those are the GP team. So when I talk about partnering, those are the people I'm partnering with to go buy because I focus on generally 100 units and more for my apartment complexes.
Gotcha.
So I partner with, 3 to 5 people. Then we go raise capital collectively from all of our limited partners or passive investors, then to go purchase the apartment.
Got it. So every
Yeah.
every individual GP is responsible for the investors that they brought on. So all the reporting and
Mm-hmm.
stuff gets done to everyone's individual investors, but you might be on the same team with other general partners who all pitch
Yeah.
in to buy the same building.
Yep. Yep.
Gotcha.
Yeah.
Okay.
Yeah.
Okay.
Exactly.
That's really cool. And so presumably there's like some sort of, however much capital that you bring to the table, that's the proportion of the profits that you get. Is that more or less how it
It
works?
it depends because there's so many components, there's so many pieces to buying that apartment. So what you earn as a GP, what your returns are as a GP depend on how many buckets you fill. So for
Mm,
example, my last deal, I found the deal. So I got a little piece of the pie just for that. I found it, I toured it, I got to know the broker, I put the offer in. So that's a lot of work. You know, so that counts as a slice of the pie. Then asset management counts as a slice of the pie. Um, Getting the loan in place and having your net worth and liquidity on the loan, that's a slice of the pie. Capital raising is a slice of the pie. So there's all these components, and then that makes up the GP portion of the deal. And
got it.
so it's not directly proportionate to how much capital you can raise. It's all these other things that you bring to the table.
Gotcha.
Mm-hmm.
So we didn't really talk about the returns that the cash flow is called, but so
Mm-hmm.
for simplicity's sake, let's call it the total return, right? So
Total
if
return.
I'm an LP in your deal, right, and let's say the
Mm-hmm.
deal is 123 Main Street. So you say,
Yep.
Jeff, I have a deal 123 Main Street. Do you want to be an LP of
Yep.
mine? I say, great, sounds good. What are the returns? And you say, we're expecting a 2x equity multiple, which we learned what that
Mm-hmm.
was. So
Yeah.
now I say, okay, cool.
Uh-huh.
You're gonna be you're gonna be teaming up with another GP, right? And presumably that other GP has passive investors like me, but they're
Mm-hmm.
under that other LP, other GP, excuse me.
Yep.
How likely or unlikely is it that that passive investor who's investing in 123 Main Street is being advertised a different expected return. Does that make sense?
It does make sense. And I think maybe where you may have, where this is more likely to happen is when you come into like a fund of funds structure where you have people raising under a fund
Okay.
and then they have their own structure for how they pay their investors.
Got
But
it.
if you were sticking just to a straight syndication and with only GPs and LPs and no fund of funds, because that's a different kind of a different
That's a different
conversation.
episode.
That's a different episode. All of the LP investors, unless there are different investment classes, but all the
Hmm.
LP investors will be given the same opportunity for the same returns.
Got it. Okay. So in other words,
So,
the GPs get together and everyone kind of shares a pitch deck.
yep, yep, and
Got it.
all the
Got it.
LP
Got it.
investors, and there shouldn't be any sidecar deals or
Got it. Okay.
that's you'll get yourself into a lot of trouble with stuff like that. But the LP investors will be treated the same. The only difference is if they have different classes of LP investors based on the amount of equity that they put in.
Got it.
And
Okay.
then every LP investor will have the opportunity. It's just a matter of what they choose to do.
Gotcha. 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 Okay. That makes a lot of
Does that
sense.
make
So
does that make
then
sense? Yeah.
it sounds like all like because in the pitch deck, you're going to have, hey, we're going to be reporting every month, let's say. So all
Mm-hmm.
the GP team needs to agree to that prior.
Yeah.
Is that fair?
Yeah. And
Gotcha.
usually, more often than not, what I've seen, every GP team does it differently, but there's usually one report that goes out to all the investors, and sometimes people put their own personal branding on it, and sometimes it just goes out carte blanche to everyone. But the same information is being distributed to
Got
all
it.
the investors on the
Okay.
same time frame, and so there's no. I mean, I'm sure it happens, anything can happen, but it shouldn't. That and different investors are getting different information. If it is
Gotcha.
happening, find a new general partner.
Well, I was wondering because I was like, man, that'd be such a not good feeling if you find out that the same deal under a different
Hmm.
GP has different returns. Better or worse, that would not be a good
Yeah,
feeling. So
it's
that
kind of like
makes
when you find out at work that the person next to you is getting paid more.
yeah, 100%. Like that's not right. So I didn't realize that. I never really thought about how GP teams work before, but that makes a
Yeah,
lot
so
of sense.
usually it's decided upfront because you need to model the returns in your business plan. You need to model based on the cash flow that you're expecting. You need to know how upfront how you're going to structure your cash flows and your distributions to your LPs in order to know how much they're going to be getting every month. So
Right.
that all goes into the analysis. There's way in the beginning before you even start raising money. So there's different structures that I've seen, but once it's set, it's set, and it goes into the investment documents. So when you're a passive investor, you get a whole lot of legal documents. It's the process is easy, but if you choose to read like anything, if you read all the legal documents, you're going to be reading for a while
Right.
because that's what lawyers are good at. But all of that is outlined up front before you invest your money. Um, and so the general partners are held to that then to follow those what they said they were going to do.
Got it. And so how how does that get broken down? So let's say you have five
Mm-hmm.
GPs on the team, right?
Mm-hmm.
And you're all buying 123 Main Street. So,
Mm-hmm.
you as Amanda have your own company, right?
Mm-hmm.
The other four GPs have presumably their own companies. Do you all
Yep.
get together and say, hey, we're going to make a new entity to go and purchase 123 Main Street? Or is it broken down in your individual companies?
There is an entity that goes and buys the apartment or whatever you're buying. But in terms of the GP, like we still maintain our own entities with inside that entity. Or I can, I don't even need a company. I could do it as an individual. But I think to answer your question, yes, a separate entity is formed to go buy that 123 Main Street, and that is going to be called 123 Main Street LLC.
Right. And then that LLC
Mm-hmm.
is operated by the five GPs in whatever
Mm-hmm.
percentage is decided ahead of time.
Yeah. Yeah.
Yeah. Okay.
Yes.
So
Yeah.
then how does it work when, if you have five people and you give them a deal and you say analyze this, you're not
Mm-hmm.
going to get the same answers and returns. You're going to get five different answers and returns, right? So how does it work
Yeah.
when you're analyzing deals? Is that one partner's responsibility? Like, okay, that's the deal analyzer.
Usually, ge- generally speaking, and in my experience, there's one person who like that's their game, like that's their gig. They love to analyze. They're good at it, and then everyone needs to buy into it because everyone needs to believe in the deal and believe that it's a
Sure.
good deal. Um, I guess thankfully, the industry does have standards. Like it's pretty common. We're not going to get wildly different answers. Like if you and I were going to analyze the deal and you were also an apartment syndicator, we wouldn't be wildly off. We may disagree on a few things, but they're going to be you're going to be able to discuss them and walk through it and figure out kind of like hopefully meet somewhere in the middle, or just maybe if we disagree so far, maybe you're going to say, I'm not going to do this deal, good luck, go find somebody else to go
Got it.
fill my role. But there are industry guidelines and data that we use to put everyone kind of in the same place. And if we're working together up front, we kind of see the same vision on how things are going to play out and how we underwrite, like what standards we use.
Gotcha.
So we're usually going to agree up front on how much we think rents are going to grow over the next 5 years. Like it's not going to be a surprise to you if I say I think rents are going to grow on average 3% every single year. You're not going to come back, and say, I disagree, Amanda. I think it's going to be 5%, and I think we can be way more aggressive. Because that's probably going to be a conversation we have up front.
Got it. Okay.
Yeah,
Man, it's kind of like dating. Like, do
it
I want
is.
to?
It is just like dating. Partnering with people is just like dating, and it's people don't realize how challenging it can be because you think of a lot of relationships and they don't last as long as these deals,
Right.
and especially when you're talking about money, and it's quite a life, not life, I don't want to say life changing, but the amount of money can impact somebody's life, and you're trying to work through this, like it can be stressful, and so you need to work
Right.
with people that you like. Date
Right.
first
Yeah.
before you form a company. Yeah.
Oh man, that's
Yeah.
awesome. I
I've
feel
seen
like
a
I
lot
could.
of partnerships go bad. Like you hear these stories, and thankfully I've not been a part of one. But yeah, you should. If you do another podcast, you could do partnership horror stories.
That would be a really interesting episode. I feel like that'd be you'd learn a lot for sure.
Yeah.
I feel like I could ask you questions for hours and hours, but we'll start to transition towards the end of the show. I want to
Okay.
focus a little bit more on just kind of your own, like how the actions you take. You're obviously a very successful person. You said you're very
Mhm.
mindset oriented.
Yeah.
I'm really interested in just how people spend their time, like day to day.
Hmm.
So I'm wondering, are there any daily routines that could be morning, evening, during the day, anything that you do that you attribute to some of your success or you really find value in?
Yeah. It's interesting because I just wrote a LinkedIn post, or maybe I responded to a LinkedIn post the other day, um, about recharging your batteries. I wrote it yesterday, and it's about just setting patterns and making time for yourself and finding things that you enjoy and that you can find gratitude in. So personally, I start every day. I love to exercise. I've been doing it for a long time, and I've really like learned to enjoy it. So every morning I go for a run, or I go to the gym. Usually it's a run, and it gets me outside, gets fresh air. It's like I call it like meditation in motion because I don't meditate, but
Hmm.
it lets me think through things. So that's what I do every single day, and then after I do that, I mean, I don't even think about it. I just wake up and do it. After I do that, then I dive into my work, and my mind is clear, and I'm able just to get going. And I've probably through my run, I've thought about, what I need to do, what I need to accomplish, maybe solve some problems, reflected on what I could have done better, and it's just how I get my day started. Besides that, it's just finding gratitude in the things and learning, taking opportunities to look back and learn from your achievements, learn from your mistakes, and just, keep focusing on the one thing and keep going. Yeah.
That's awesome. I like that meditation in motion.
Yeah. I
We'll
don't have the
definitely use that.
patience to meditate.
Besides Rich Dad Poor Dad, besides that little purple book, have there been any other books that have had just a kind of outsized impact on your life, be
Yeah.
it professional or otherwise?
Yeah, a couple. So Cash Flow Quadrant again is like it dives a little bit deeper into Rich Dad Poor Dad, but outside of the purple books, there's Maximum Achievement by Brian Tracy, and it's a little bit, I don't know when it was written. It's not fresh off the shelf, but I've read that one a couple times, and I've gifted it to a few people. That was definitely moved the needle for me. And then another classic is How to Win Friends and Influence People. Another classic I always fall back on. So I find that a lot of books that people are recommending that are maybe, I don't want to say, yeah, newer, for lack, I can't think of a better word right now, are just the same stuff regurgitated. So oftentimes you just go back to the classic and you can get the original version.
Yeah.
Yeah. And then if you want to get technical, it's Raising Capital for Real Estate. I mean, that's not going to appeal to everyone unless you're raising capital for real estate. But if you are, that's
Hunter's book?
That's a good one. Yeah. Yeah.
Cool.
Yeah. That's, again, if you fall into that category, definitely worth a read. But if you don't fall into that category, then it's probably not.
And last question of the day, what are you looking for now? How can people help you or reach out or be of service to you? What are you looking for?
Yeah, well, I think it's just, if you feel like maybe you want to start investing passively, I think I think and I believe that everyone deserves financial independence, and that's what everyone should be aiming for. Even if you love your job, you love your trade, you love your craft, having that opportunity and optionality in your life is really empowering. And so I would love to, I'd love to talk to you about it, if you think you'd be a good fit. And then if you always, looking to partner or just want to collaborate on something, feel free to reach out to me. I'm open for discussion. I'm most active on LinkedIn. You can find me just under Amanda Larson. And then my website is my email is Amanda@AMAX, it's AMAX Equity.com. So yeah, if you just want to have a discussion, collaboration, talk about investing, I just love to talk.
Amazing. And yeah, we'll definitely include links to your website and your LinkedIn profile in the show notes. So Amanda, thank you so much for coming on. I really, really appreciate you and your time. And thank you for teaching us about real estate investing.
No, thank you, Jeff. It was a lot of fun. I really appreciate it, and hopefully your listeners learn something from it or glean something from it. Just had fun listening to it. So thank you so much.
Thank you. Have a great one.
Thanks, you too.